Hello, and welcome everyone to today's session on the path to profit and understanding break-even dynamics. My name is Humberto Ijar, and I'll be very happy to walk you through this presentation today as we move forward in our efforts to understand these lovely concepts. Session objectives. We're going to learn and utilize key financial terms. Okay, key for our development as entrepreneurs, key for understanding the growth patterns of the business, and then key for really nailing down productive and conducive practices of recognizing these terms and utilizing them in different financial documents. Okay, we're going to identify the unique types of costs businesses may incur. We're going to start distinguishing between different types of business costs also based on their characteristics. We're going to learn and demonstrate the manual calculation of a break-even method. Think of that, manually calculated. No technology, well, maybe some calculator technology, but other than that, pretty manual. All right, and then lastly, we're going to increase the confidence. It's a big one, increase the confidence when working with numbers. That's the whole point here. That is the whole point of these exercises. That's the goal with all of these workshops, is increase that confidence in working with numbers, allow them to talk to you in a very natural way, and utilize them in a very strategic manner for the business. Cool? Here we go. We're going to differentiate between business expenses and personal expenses. That's a big one. As we're starting our entrepreneurial journey, it becomes paramount to differentiate the two and understand the relationship between the two and where to cut off those relationships. All right. A business expense, we can see it here. Any costs that a company has to pay in order to run and make money, such as rent, supplies, or employees' wages. Personal expense, on the other hand, is any cost you pay for your own needs or lifestyle. Right? Groceries, rent, mortgage, entertainment. For you, those are on you. Those are your personal expenses. Clear? Business, anything that has to do with the business, pencil, paper, anything that you purchase for business's use, for the use of a business, all of that has to be business expense. Anything else for personal gain, entertainment, and all of that, personal. Pretty clear? Okay, here we go. Let's put it into practice. Imagine a business owner runs a small bakery, right? One day, they buy flour and sugar to make bread and for the customers. This is business expense. We're making bread for our customers, right? It's used to run the bakery. And it's used to sell at the bakery. Later, though, here we go. The same owner buys groceries for the home, including fruits, snacks for the family. Of course, this would be personal expense. It's for the household. It's for the own use, not the business. Good. Hopefully that distinction is clear. Then we're moving on to understanding the differences help manage your finances, and it helps us it keeps personal expenses on their own category, keeps business expenses on their own category, and it prevents us from intermingling the two. This becomes really important when we're reporting business expenses, business taxes, any financial documentation that we need to do for the business. This then becomes paramount. When we start intermingling those expenses, we can get into huge issues, potential fines, and maybe bigger things. So let's keep in mind what's for the business, what's personal. That's going to be for us, right? Huge recommendation for all entrepreneurs. As you're growing in your entrepreneurial journey, business bank account, paramount. All of the expenses and all of the revenues for the business that come in and out of the business through that business bank account, anything personal bank account. So separate those two from the beginning, or as close to the beginning as you can, right? Trust me, you'll thank us later. Trust me. It's just, if you don't do it, huge headaches. Huge headaches. Huge issues may come your way. Please prevent it. Do it proactively. Do it from the beginning. Here we go. Okay. We're going to talk about variables here, and we're going to differentiate two things. First, we're going to talk about variables. For now, we'll address it now. It's a noun, of a quantity, able to assume any numerical value. That's a variable. If you think back to mathematics classes, that's what we saw. Any variable, name it X, Y, Z, however you want it. And then we're also going to talk about varying. So something that's varying. This is where we'll utilize as an adjective. We're going to differ in size, amount, and degree or nature. So that's going to be varying. So we'll use both variables and varying. Okay? In this class, we will use the noun form of variable. In math, meaning that that the value depends on the specific but changing factor. Okay? Very specific, but maybe, perhaps, changing factor. Good deal? So far, so good. Here we go. Fixed expenses. So this is the first type of expense that we're going to explore within this workshop. Expenses that are fixed are going to be expenses that are on a monthly or recurring basis. We'll call them that way. That are paid regardless of whether or not we sell, right? These are expenses regardless of whether the business makes a sale or not. These are things that we have to spend on, whether we're producing, not producing, but this is to keep things afloat. Examples of these are going to be rent, utilities, insurance, advertising, phone, and then some administrative salaries. So if we start thinking about this, none of these, or actually say all of these, we have to spend. These are all expenses that we have to perform whether we're producing or not, whether we're selling or not. We have to pay the rent, right? If we want the business to continue to move forward, we have to pay the rent. We have to pay utilities. They're not fixated on whether we sell any number of units, right? Insurance, have to. Advertising, not tied to the number of units sold. Phone, all of these are not tied, and they absolutely have to be made. Therefore, they're classified as fixed expenses. All right? Tie-in questions. Some of the questions that you can ask yourself to think or to start categorizing these expenses is, does this expense stay the same amount each month, regardless of sales or production? If it's yes, more than likely it's going to be a fixed expense. Is this cost required to keep the business running, even if no products or services are sold? If yes, fixed expense, right? Can this expense be easily predicted or budgeted for over a long period of time? If yes, fixed. Got it. Budgeted. Easy. Out of the way, right? All right. Does the amount remain constant regardless of the business activity levels? If yes, fixed expense. And lastly, is this expense part of ongoing operational costs like rent or salaries? If yes, ding, 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 you got it, fixed expense. All right, so again, if it's ongoing, if you can predict it, if you can budget for it, if it doesn't, if it's not tied to the level of production, fixed expense. Good deal? Yeah, having trouble saying fixed, but fixed expense. That's what it is. Ready? Here we go. Variable. This is the other type of expense that a business may incur. Expenses that are directly related to the production and or delivery of a product or service. Okay? These are directly tied. Examples, materials. So the materials that we're going to utilizing as inputs to produce our final good, those are variable expenses, right? The more we sell, the more materials we're going to incur. Labor. The more we produce, the more we sell, the more labor we're going to require. Shipping. The more we sell, the more we ship, right? Directly. If we're shipping our products, then every time we sell and we're shipping, that's directly tied to. So the more we sell, the more we're going to ship, variable costs. Packaging, same deal. The more we produce, the more we sell, the more we're going to need to package that beautiful good together with a nice little package. And here you go. All right. So all of these examples of variable costs. That means that we can't really budget for them. We can sort of start to predict, but we would have to look at the cyclical nature of our business in order to do so, right? There's no like one line across on our financial statements. It's like, all right, $100 for materials. It doesn't really work that way because we're going to run into cyclical things, cyclical rhythms of sales. Good? All right. Variable, tied to the unit. Tied to the level of production and sales. Here we go. Putting this into practice. So, some of these items that can be identified as either fixed or variable expenses. How would we categorize these expenses? Materials, we just saw them, right? The more we sell, the more materials we're going to utilize. So that's going to be a variable cost. Good job, all of you online. Salaries. This one, we saw them as fixed. This can vary. Ooh, we're going to utilize the word that we just defined in earlier slides. This may vary. So if these are salaries that are operational, kind of like your HR person, your front desk person, your CEO that's not technically related or isn't paid due to the amount of sales, like those are going to be fixed. But if you've got a production salary, somebody that comes in and helps with the production, that's going to be variable, right? Because the more you produce, the more they produce, the more they'll incur as a salary. So that one's a little bit of a tricky one, but that's fine. We'll figure it out as we go. Insurance. We're gonna have to pay it, regardless of whether we sell or not. Right? Keep the business afloat, keep it secure, keep it safe. Fixed. Utilities. Same. Fixed. Have to pay them. Rent. Pay it. Rent. Fixed. Shipping. Well, if we're shipping, means that we're producing, and if we're shipping, means we're selling. So that's going to be tied directly to the cost of goods. So that's going to be a variable expense. And then costs. That's a tricky one. It can be either or, right? Depends on what the cost is. Is it for the production? It'll be variable. If it's just a regular cost, a cost that we can explore every month and we can budget for every month, and it's just straight across the board for the year, that's going to be fixed. Good. So hopefully by now you're getting the hang of it. You're getting the rhythm and the cadence of of how to classify these different expenses. If not, come talk to us. We'll help you figure it out. Okay. Let's move on to the revenue side of things. What is revenue? So we have this as a definition. It is the total income a business receives from its regular operations. It comes from selling products or providing services. That's where the revenue comes from, right? Before any expenses are deducted, that's what we classify as revenue. So revenue is anything that comes in for our products or services before expenses are deducted. Revenue, okay? We have here, it's the starting point for measuring a company's financial performance. Yes, it is. It's the starting point. Not the whole point, it's the starting point. What does that revenue do then for the rest of my company, the rest of my operations? Does it cover all of the expenses that I have in place? Does it? All right, here we go. We'll have this term called cost of goods sold, and it's a really important one for us to understand, to comprehend now and then understand the relationship that it has with the business overall. We have the definition here: the total sales of a business minus the total cost of goods sold. The cost of goods sold is the sum of all of the expenses accumulated after selling in production the products or services. So everything that goes in, all of the inputs that go into producing the final good, that is my cost of goods, right? It's all of this, it's the sum, we've got it here, simplify it, sum of all the variable expenses. Everything that goes in for the production, add them all up, that's going to be my cost of goods, right? Really important term to familiarize ourselves with. We'll use this all the time, especially as we're exploring all of the financial documents that are coming our way. Profit and loss, statement of cash flows, balance sheets. It'll interact with all of them, some of them directly, some of them indirectly, but it will interact with them all. Okay, so it's a really, really important concept for us to start familiarizing ourselves and then becoming more comfortable in the usage of it, right? Cost of goods, all of the variables. That's what it is. Simple formula, that's the one to remember. Cost of goods sold, COGS, we utilize it all the time in the financial lingo. COGS equals sum of all variables, all variable expenses. Here we go. All right. Profit. We saw revenue. We're looking at COGS. We're looking at cost of goods sold. Now we see this little word profit. What is that? What is this? What does this mean? Well, I've got two types of profits here. We've got gross profit, and this is the total sales revenue of a business minus the total cost of goods. So we've got profit and we've got revenue, right? Revenue, it's the total sales, but then we're going to subtract the cost of goods, and that's going to give us gross profit. Make sense? Not complicated, right? Easy peasy. That's it. That's it. Revenue, the sum of all the sales. But then we subtract the cost of goods, everything that went into all of our variable expenses, everything that went to producing that, and that's what gives us the gross profit. Make sense? Revenue minus cost of goods equals profit. Here we go. Okay, we've got a little example here on your screen. If we have $1,000 in sales, revenue, minus $350 in cost of goods, all the variable expenses, that's going to give us $650 of, you got it, gross profit. Gross profit. That's what it is right now. Right? Now, we got this beautiful little gross profit right there. That sounded weird. We've got this gross profit here of $650. Now we're going to figure out what my net profit. How does it go from gross profit to net profit? That's the one we care about, right? Well, we care about all of them, but that's the one that's going to reflect the bottom line. So here, we see here that the total sales of a business minus all of the expenses. So it's going to give us a net profit. So total sales, revenue, minus the variable costs, which are cost of goods, minus the fixed cost, that encompasses all of the expenses, then will give us our net profit. So we've got it in the formula. Total revenue minus total expenses, variable and fixed together, right? Combine them two, get the subtraction, and we can see here in our little sample here that we have a net profit of $1,000. I'm sorry, a revenue of $1,000 in sales, minus $750 of total expenses. So this is COGS plus all of the other fixed expenses. That's going to give me $250. That is my net profit. That's going to be my bottom line. We care about that one very much because that is another way to gauge profitability or the health of the business. Make sense? Hopefully that wasn't too confusing, and hopefully I was able to explain it clearly, but that's what's it. So so we've got gross profit, we've got net profit. Gross profit, sales after sales minus the cost of goods. Net profit, it's sales minus all of the expenses. All of the expenses. That's what's it. Good? Here we go. Putting it into practice. All right, give me one more sample, Humberto. You say, here we go. Emma owns a coffee shop and it's working on calculating her gross and net profits for the month. This month, she made $1,000 in sales. Brilliant. Great. Good job, Emma. All right. Gross profit then will tell us, the calculation is that if she makes $1,000 in sales and spends $350 on coffee ingredients, her gross profit is going to be $650. These are the ingredients, the inputs, the variable costs going into those sales. Right? Okay. Cool. Great. I've got my gross profit of $650. Then I'm going to go to next net profit. So then, after accounting for additional expenses like rent, salaries, that's going to give me a total of $750. So the $750 is their variable cost of $350 plus all of the other fixed costs. That's going to give me $750. And then we're going to calculate that the net profit is $1,000 minus $750 gives us a result of $250, being that the net profit of Emma. Woo! Not that hard. Not that hard. Hopefully. Okay. Then we've got something called the gross profit margin. This one's interesting and really, really cool. One of my favorite margins, one of my favorite ratios on the personal side. Okay, so we've got the definition here for gross profit margin. Gross profit margin shows the percentage of sales, revenue remaining after subtracting the cost of goods sold. Okay, to calculate it, here's a little formula. Gross profit margin equals the total sales minus the cost of goods, right? So total sales minus the cost of good. Anybody remember what that it was? Gross profit. There you go. Here we go. Oh, good job. All right, total sales minus the cost of goods divided by the number of total sales. All right, if we remember from our sample before, we've got $1,000 in total sales. We've got $350 in cost of goods. Subtract one from the other, you're left with $650. And then if you divide that by $1,000, which is the number of total sales, it gives you 0.65 or 65%. Isn't that cool? So that's what it is. It's the ratio of sales versus your costs of goods. Really cool. Really, really cool. Really important ratio. We'll learn how to use it a little bit later more and how to engage in what it means for your business. Okay? All right, here we go. We're going to go over break-even analysis now. This is a company called Happily Ever After. I think this is the intellectual property of my good friend Sandro Tonini. He came up with this example, Happily Ever After. That's very cute. Okay, it's an apple orchard business, and we're going to function as so. We're going to see what it entails, and we're going to conduct a break-even analysis on this particular company. Okay, we're going to try to make it as simple as possible and really as conducive to real-time analysis and then strategy thereafter. It'll inform you what kinds of things we can do with our price, with our costs, either both fixed and variables. Here we go. Okay. Explore the variable costs for Happily Ever After. We've got here as a question, we're posing as a question, how do we calculate the variable cost of an apple? Well, let's consider everything that goes into the production of an apple, which sounds weird because apples are produced naturally. But nonetheless, here we go. So things that are going to go into the production of an apple. Wax. Did you guys know that there's a little wax cover in the thing? Yeah. Okay. So wax. We'll consider that. 15 cents per apple. Okay. These are all per one apple. Barcode sticker. 10 cents. Call it that. Labor. 15 cents per apple. Pulling it down from the tree. One apple. A bag. 5 cents, maybe. And then delivery, 5 cents. So combine all of the costs. All of these are variable costs. We'll combine them all. It gives us 50 cents. Great. So we deduce then that our variable cost for the production of one apple is 50 cents, right? Adding up all of the costs. Wonderful. What does that mean? How do we utilize it? How do we move forward with this information? Well, let us analyze the fixed costs now. So we've got here that it costs us $10,000 to rent this apple orchard. Telephone bill is about $2,000. It's a large telephone bill. That is a very large telephone bill. And then we've got a loan payment of $1,000. Very decent. We've got salaries for personnel in the office, $5,000. We've got business insurance for $2,000. Great. We've got tractor maintenance, $2,000. Those tractors need their maintenance, and that's like big and expensive. So $2,000 a month. Okay. Accountant, $3,000. Must be a really good accountant. Okay. So total fixed costs for 1 month. Right? Remember, these are monthly costs. Total fixed costs, if we add them all up, $25,000. Great. Slide before, we had 50 cents. Now we've got, as variable cost, now we've got $25,000 for fixed cost. Great. What do we do this? What do we do with this? So let's consider the price of an apple. So we've got variable costs, we've got fixed costs. Now let's consider the price per apple that we're wanting to install. And we'll figure in the beginning that it's going to be $1 per apple. What do y'all think? Too expensive? Not expensive enough? Too expensive? All right, here we go. Well, let's see. With our example, this is what it's telling us. If we have the price of an apple at $1 and we have the variable cost at 50 cents and we have the fixed cost at $25,000, what can we expect? Okay, so the break-even analysis will go as such. we would have in our formula fixed costs, right? And then we'll have the unit of price, and then we'll have the variable cost per unit. So all three components are going to play a role. Our formula will say fixed cost, total number of fixed costs, over the unit of price minus the variable cost per unit. That make sense? Not yet? That's okay. We'll see the example here. That's going to give us the units required to break even. That's not going to be and break even will mean whatever your company needs to break even, right? We'll do the analysis as well. But in this case, in order to cover the fixed cost and the variable cost, these are the number of units required to be at zero, right? The company neither gains nor loses money at this point. Okay? Here we go. This is the example. So if we've got $1 as a price and 50 cents as a variable cost and $25,000 in fixed costs, that's going to give us $25,000 over y minus 50 cents. $1 minus 50 cents, that's going to be 50 cents. So $25,000 over 50 cents or divided by 50 cents, that's going to give us 50,000 apples. 50,000 apples a month. So what I'm saying, or what you're telling me, this is the analysis, is in order for my company to break even, I need to sell $50,000 apples a month. 50,000 apples a month to break even. It doesn't say that I'm earning any profit yet. I'm not losing money either. That's a heck of a lot of apples, though. It's a heck of a lot of apples. Okay. All right. So, that's a lot of apples. What can we do to break even? A natural question should come to you and say, is there anything I can do to reach the break-even point with less sales, perhaps? $50,000. 50,000 apples is a lot of apples to sell a month, mind you. Okay. Well, let's recall the three variables that we had initially that influence the break-even formula. Unit price, fixed cost per unit, and then variable cost per unit. The first one we're going to explore, or the first one that might pop up naturally, is what if we adjust the price per unit? What if we sell it for a higher price? That's a great thought. That's one of the things that we can influence, right, or we can control. So in this case, what if we increase our price to $1.20? $1.20 per apple. Okay. Fixed costs remain the same, $25,000. The unit price increased from $1 to $1.20. The variable costs remain the same, 50 cents. So 25,000 minus or over 70 cents, $1.20 minus 50 cents, that's going to give us 70 cents. So $25,000 over 70 cents, it's going to give us 35,714 apples per month. Whew. Okay. A lot less. I mean, it's better than 50,000, and that's only with a 20% with a 20-cent increase in the price. So this is the effect of only increasing 20 cents, right? We might increase it 40 cents. We might increase it 50 cents. Every adjustment will dictate and will affect absolutely the break-even point, right? The formula holds itself as such. And so this is one of the adjustments that we can do. What else do you think we could do? Well, we could adjust. We can maybe find a way to decrease our fixed costs. Maybe we can work out a deal with the rent. Maybe work out something better for the repairs and maintenance of the tractors that are not that expensive. We can explore ways to reduce the fixed costs. So reducing the fixed cost will reduce our break-even point as well. Reducing the variable cost will also affect it the same way. So if we can find a way to maybe like buy the stickers in bulk or buy the wax in a bigger bulk, so the price per unit decreases, right? So all of those things, these three components may have adjustments. It's all about exploring what routes we have, right? The price is an easy one for us to do because we control the price. Now, we have to be mindful of how that will affect the demand of our units, right? So the price, if it has some elasticity, let's figure out how much that is. again, come talk to us. Let's have that conversation. Let's have that conversation and see what we can do. But that's an easy one to adjust. The other two require a little bit of more research and then negotiation with the different parts. But those three things, this is a very quick and easy, hopefully easy, example of how to create a break-even analysis, right? This is to say the break-even analysis is at a point where your company is covering all of the expenses that are both for production and operation, but it's not yet necessarily creating any profit for you, right? The net profit is, and most times, at zero if we are at this break-even. If we find ourselves at this break-even point. Anything we sell above the $35,000 or the 35,000 apples is going to affect our net profit. Anything below, we're going to need to cover somewhere else. That point, that 35,714 apples per month, it tells us you need to sell at least these many in order to be at zero, right? So again, let's explore how to adjust price, variable costs, fixed costs, and it will absolutely change the outcome of your break-even analysis. That's all I've got for you today. Quick and easy, hopefully, and painless. See you in the next one.